Welcome to Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. President Trump telling NBC News he'd be willing to lower tariffs on China at some point. The president also saying today a fair trade deal with China is his main focus. Warren Buffett announcing he will step down as CEO of Berkshire at the end of the year. The Oracle of Omaha criticising the US administration's tariff policy, saying there are lots of opportunities in India, but that will be something for Berkshire's future management to consider. State Bank of India expects flat loan growth this year as India's largest bank warns tariffs will start to impact the macro economy. Thin on the ground in terms of trader volumes in the Asian markets. Japan, China, Hong Kong and Singapore are out of play today. In the meantime, US President Trump telling the press just hours ago that trade agreements could, quote, very well be announced this week, but that he has no plans to speak with Chinese President Xi Jinping just yet. He spoke more about China in an interview with Kristen Welker on NBC's Meet the Press overnight. Take a listen.
You take me to my next question, which is about China. They've been making a number of public statements.
Very positive statements the last 24 hours.
Well, and most recently, they said before talks could happen, the U.S. would need to remove unilateral tariffs. Would you consider dropping the tariffs to get China to the negotiating table?
No. First of all, you're giving me a statement that was said a week ago. You're not giving the statement that was said today.
I have May 2nd Chinese Commerce Ministry.
Do you know what they said today?
The U.S. wants to negotiate. It should show sincerity by preparing to take actions in correcting its mistakes and canceling the unilateral tariffs.
They made, first of all, they made numerous statements.
Yes, they've made numerous statements.
You know how many people speak for China? It's like 50
they've made numerous statements.
I can give you a statement for any occasion.
Yes.
But they said today they want to talk. Look, China, and I don't like this, I'm not happy about this, China's getting killed right now. They're getting absolutely destroyed. Their factories are closing. Their unemployment is going through the roof. I'm not looking to do that to China. Now, at the same time, I'm not looking to have China make hundreds of billions of dollars and build more ships and more army tanks and more airplanes.
So you're not, just to be very clear, you're not dropping the tariffs against China to get them to the negotiating table. Those tariffs are staying on.
Why would I do that?
Would you lower them?
At some point, I'm going to lower them because otherwise you could never do business with them. Yeah. And they want to do business very much. Look, their economy is really doing badly. Their economy is collapsing.
The Indian markets join us in about 45 minutes' time. Let's give you a sense of what to expect with the open and take a look at Gift Nifty futures, which are teeing up an opening number in the region of 24,530. So that would mark a lift from where we left off on Friday's session at 24,346. Let's give you the dollar rupee exchange rate post payrolls, which were constructive, weren't they? 84.4330 is where we stand. The price of oil sinking over 3% in Asian trade to its lowest in weeks. Right now, this is what the global indicators are doing in the energy complex. WTI down by almost 4%. Brent crude down by almost 3.5%. This is good news for India, of course. Not such good news for the major oil exporters and OPEC. So now we have oil prices in the mid to late 50s. This, as OPEC Plus says, it will accelerate output hikes, raising output again in June by 411,000 barrels per day. This is the second month in a row that the group has decided to raise production quotas. India is a net importer, and lower prices could be a tailwind for the Indian economy and the markets. We are also watching heightened tensions between India and Pakistan. India has now suspended all imports from Pakistan following a terrorist attack in Kashmir that killed 26 tourists. Imports have already been coming down in recent years and are now set to log zero after this ban. The two nuclear-armed countries have been increasing military exercises and tests. Pakistan on Saturday released a video showing the test launch of a surface-to-surface missile. Islamabad has been warning that it has credible intelligence warning a military attack by New Delhi could come any time. Meantime, the Indian Air Force conducted A training exercise showcasing its fighter jets landing on a highway airstrip. Despite all of that, veteran emerging markets investor Mark Mobius is remaining bullish on India. This is what he told Squawk Box Asia earlier today.
Biggest love is India. Obviously, that's the country that is going to be continuing to do very well going forward. Not only because of the movement of manufacturing from China, but more importantly, what is happening domestically. You've got a country that is young, that is now grasping the technology that we see around the world. And it's an incredible, very, very exciting area to see.
And we are in the thick of earnings season. India's largest bank, SBI, State Bank of India, reporting a 9% net profit decline in the fourth quarter. The lender was pressured by narrower net interest margins. SBI is also accounting for the impact from global tariff uncertainties. The state-owned bank now aims for loan growth of 12 to 13% in 25-26, almost flat from the prior year. In the meantime, profits also shrinking for Kotak Mahindra Bank. The private lender saw quarterly profits drop 14% on year. Kotak's solid loan growth was offset by a surge in provisions for potential bad loans. Let's get more on the banking space with Rahul Jain joins us now, Head of Asia Financials and India Equity Research at Goldman Sachs. Rahul, great to have you on the programme and welcome to Inside India. Help me understand, first of all, why you are less cautious and more constructive on India's banking sector.
Good morning, Sri, and welcome to be in your studio. So look, we really like the setup for Indian financials, particularly starting from last month when we upgraded the sector. Literally right after the Liberation Day announced by the US president. I think a couple of reasons why we started to turn more constructive after not being so positive on the space for the last 2 to 3 years. There are a couple of reasons for that. The number one reason is the bottoming out of the NPL concerns. So we believe that we are perhaps at the fag end of the NPL cycle that the Indian financials witnessed, emanating essentially in the unsecured loans. In addition to that, we believe that the profitability will start to bottom out in the next 1 or 2 quarters. There has been one important change that has happened in the space over the last couple of months, and that is that the regulators have started to support the sector. You've seen a slew of reform measures or the supportive measures taken by the Reserve Bank of India over the last couple of months, importantly around the liquidity. And that's, again, being supported by inflation being under control. That is a great news for the financial space because for the last 1.5 years, we had tighter liquidity conditions prevailing in the system. So clearly these two things would mean that the EPS cuts would start to bottom out. And the fourth quarter results actually validated our thesis to a large degree, wherein we see some of the large lenders report earnings beat. And that led to the revisions of the earnings for those lenders.
There is a wild card in the pack, though, isn't there? And that is credit growth. I know you're watching that closely, given the prospects for slower growth in this tariff environment broadly. What's been priced in, Rahul? What are the tail risk events in the consumer and business credit cycle that you're watching that could upend what is, as you say, a positive earnings growth story?
Certainly. So look, credit growth is naturally going to be slower in this period. For a couple of reasons. Number one, the household balance sheets are still being repaired. And I think the confidence would start to emerge perhaps in the second half as we wait to see what the measures of the government of India's tax cuts do to the households. So you will recall in the last union budget, the government announced the income tax cuts for the households. That's a stimulus to the extent of about 1.2 trillion INR. Worth of tax cuts being given out to the households. Number one. Number two, the households are consolidating the balance sheets as well. We have seen the decline in the origination volumes for some of the loan segments such as mortgages, etc. So we are in a phase of consolidation, which is a healthy sign after having seen heady growth over the last 2 to 3 years, which made even the Reserve Bank of India concerned, and that led to the increase in risk weights on those loans.
Can I raise this with you, Rahul? We've been hearing a lot about a brewing household debt crisis among India's middle class. Is that an overblown risk or is that a real risk?
Clearly, it was a real risk. Goldman started talking about it back in June 23, and then we saw Reserve Bank of India took the right measures of warning the system by raising the risk weights on these unsecured loans, and that led to a slowdown in the unsecured lending for the households. I think now we got to a stage where the households are consolidating their debt. The government of India has given them the tax cuts. And the interest rates would also reduce the EMI burden, or particularly on the mortgage loans, which will also add to the disposable income. So clearly, we are in the middle of the consolidation phase, which should lead to a pickup in the later part of the year and perhaps in the second year. But that is definitely a real risk, a joker in the pack, as you rightly said. But we believe that we'll still be okay at 10 to 12% credit growth. And just one last point to make here, it is also supported by a healthy real GDP growth of north of 6% in India, leading to a normal GDP growth of, let's say, about between 9 to 10%. So on the back of normal GDP growth of 9 to 10, a 10 to 12% credit growth is something that the system can witness over the next couple of quarters.
If we pop the hood, so to speak, on the underlying economy, what are the credit spreads telling us about where we are in the cycle, and are they flashing any warning signs?
In fact, I would say that there are no major red flags after this recent unsecured cycle that the system has managed to handle. The credit spreads clearly are being benign, whichever way you see it, be it on the interest rate side as well as the risk indicators. We track some of the bureau data quite closely to see whether there are any major risks building up in the trenches. And I feel that, the red flag concern is by and large behind us. Having said that, of course, there are risks as we talk about on the global side. We all know the potential slowdown of the global GDP emerging from the tariff, concern that are going on in the global economy. And while India, on a direct basis, will still be able to manage it better, relatively speaking, to many other economies, there is always going to be indirect risk because of the reliance of the services sector, particularly the GCCs in the IT-enabled sector, on the US economy and the global economy. But having said that, we believe that the improvement that we are seeing in the household space should be able to absorb it and manage to overcome any potential risks.
Especially now that the RBI has embarked on what appears to be an easing cycle. Where is that leaving margins, though, and what outlook do you have for the major banks?
Absolutely. So look, Indian banks had a Goldilocks period when the rates were going up. They witnessed massive, margin expansion. Now, of course, our house view is that the RBI will cut rates by about 100 basis points. A majority of should be reflected in the first half of the financial year, which is by September of 2025. Thereafter, we should see some benefits starting to come through. So in the initial phase, the repo rate cut will lead to a drop in the yields on loans for the banking system or the financial system. Thereafter, the cut in deposit rates and the improvement in the funding cost due to the liquidity surplus in the system should allow support to the margins in the second half. So we feel that by first half, most of the NIM compression should be by and large done with. And thereafter, we should see improvement in the margins driven by the reduction of the deposit rates. Though competitive intensity could remain a legit risk in the later part of the year.
Whether it's disinvestment of government holdings and stakes, M&A, what are the prospects for consolidation in the Indian banking space? And can we talk about any areas in the space that may have a takeover premium associated with them?
Interesting question. Look, in a slowing growth environment, it is not wrong to think about a potential inorganic activity happening in the space. Having said that, I think the system has dealt with a lot of challenges in the last 5 to 7 years. So the M&A, unless it comes with a lot of complementarity, unlikely that it will happen only because of the systemic growth being low. So in our base case, we don't envisage any such episodes to happen. But look, there are always unknowns out there that the market would be willing to take it in its stride. Having said that, I think the overall story of Indian financials now coming out of the unsecured episode seems quite robust and looks like pretty healthy outcome for the sector over the next couple of years.
If you could just give us a bit more colour on asset quality, Rahul, and specifically non-performing loan portfolios at the systemically important banks, what do they look like?
So most of the banks are reporting slippages in the range of 1 to 2.5%, but the credit cost, which is the right barometer to gauge how much your P&L is exposed, is seeming to be under control. It's in the range of, let's say, about 40 basis points to about 60 to 65 basis points. And in some of the second-rung bank, it is in the range of 60 basis points to about 2.5%. So well within the operating profitability that the banks make. And therefore, we are still seeing the ROAs being positive. And for some of the banks, actually, it remains at the peak levels that they have witnessed in the longest history. So I would say that the ROAs and the return ratios, despite seeing a surge in credit costs, remains quite comfortable for the Indian financial sector at this point of time.
Thank you for that, Rahul. What's in it for income investors? And what is the plan for those banks that are holding excess capital? What is the plan on that front? What can we expect in terms of dividend growth and payouts?
Sure. So look, I mean, Indian economy is a growth economy. The financial sector has always been plowing back the earnings they make. The dividend payout ratios has traditionally been around, 20-odd% for the larger banks. We expect those to remain around those levels. But the capital levels are very comfortable for the financial sector. Most of the companies are holding 5 to 7% higher than the required capital base by the Reserve Bank of India. So clearly, if the growth doesn't come back in the next couple of years, the lenders will have to go back and revisit their dividend payout strategy. But at this point of time, investors views the Indian financials more from the growth standpoint rather than the dividend payout ratios. And I think that continues to be the story for the next couple of quarters to come.
It's been a bit stop-start in terms of the IPO market, hasn't it? So what does that mean? What's been the read-through on the banks in India that are underwriting and supporting and advising these deals?
So look, I mean, the IPO market appears to be still, quite healthy.
Yes.
Though, of course, there has been a hibernation because of what's happening in the global markets.
Yes.
But if you see the filing, etc., that continues to remain healthy. But, for the financial sector per se, it is more of a capital market play than the banking system play, just to the extent that, banking system does benefit from the flow, but has been negatively impacting the CASA ratio for the banks. CASA essentially is the low-cost deposits, where the funding cost is substantially lower than the term deposits. So that has been impacted, and that has impacted the NIMs for the banks in the last, couple of years, because the financial savings have moved towards the capital markets. Having said that, with a thaw in the capital markets, there has been some stabilization in the CASA ratio also. So a not so buoyant IPO market in the near term is positive for the lenders because the CASA ratio start to stabilize. But for the whole economy, financial savings is important. Therefore, the IPO market is important, and that will breed to more of the financial products being taken off. So bottom line is, we believe that IPO market should come back, and that should support the overall development of the financial savings. But with rates coming down, the CASA ratio will start to stabilize for the financial sector.
Interesting. Just very quick one, Rahul, before we go. If there is an India-US trade deal, it feels like India is at the front of the queue, then can we expect to see the banks gap higher on that headline, or is that already more or less in the price?
Look, I mean, the financial sector is a derivative of the macro.
Exactly.
So if the US-India potential trade deal brings more business to the country, then eventually it should benefit the financial sector to the extent that the macro benefits from it. But in our base case, we continue to believe that we should have a credit growth of about 10 to 12%, ROAs improving in the second half, NPL risk is by and large behind us. So long as this trade deal either supports or improves the fundamentals, banking sector would benefit.
That's a constructive backdrop for the banks then. Rahul, we'll leave it there. So thank you very much indeed for joining me. Rahul Jain there, Goldman Sachs. We're back in 2 minutes. Welcome back, everyone. One major market story that we are watching: Warren Buffett announcing he's stepping down from his position as Berkshire Hathaway's CEO after 6 decades at the helm. The surprise announcement came at the company's annual shareholder meeting on Saturday. At the end of this year, Buffett will be handing over the reins to Vice Chairman Greg Abel, whom he'd designated as successor 4 years ago. Abel inherits a conglomerate worth $1.16 trillion, holding $264 billion in stocks, $348 billion in cash and 189 operating businesses. The company's increasing cash pile seen as a signal of its increasing caution towards markets. Warren Buffett urging investors patience, but also adding that the trade war is, quote, a big mistake.
Trade should not be a weapon. And the United States, we've won. I mean, we have become an incredibly important country, starting from nothing. 250 years ago, there's nothing been anything like it. And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done.
Warren Buffett's major investments is in the Japanese trading houses. Lynn joins us now to give us a bit more colour on this. And this is a long-term, we're talking long-term investment for Berkshire.
Absolutely. He was asked about these investments and he said, we're going to be in it for the next 50 years, potentially forever. And he says we've got a $20 billion investment in these 5 major Japanese trading houses, but we wish we had 100 billion invested. But, we know that since Berkshire Hathaway first got into these 5 companies about 5 or 6 years ago, he has been actively investing, so expanding the minority stakes in each of these soshas, and recently in a letter to shareholders saying that basically he's been able to negotiate flexibility in terms of that 10% ceiling here. So as you can see there, these are the latest filings in terms of their stake, just sitting below that 10% level overall. But, his comments really highlighting why he was so interested in these companies in the first place. The fact that they are quality, and even still today, cheap valuations, if we have that chart as well, versus, for example, the averages on the S&P 500. If you look at the price to earnings for some of these companies, we're talking about, sort of levels below that 12 mark for the price to earnings ratio, and then around that 1 mark for the price to book ratio as well. And then I think there's a couple of other things here, right? He's been able to leverage the very low borrowing costs in Japan as well, because he's been able to buy these stakes through yen-denominated bonds as well. Also, the corporate governance drive as well. A lot of these companies are also very cash-rich and have been very active in terms of buybacks as well as upping dividends. And then also just that strategic alignment as well, particularly in terms of the commodities and the energy exposure of these sorts of companies, and also his own.
There has been a degree of strategic ambiguity in terms of how Berkshire is positioning, or has been positioning, in India. Are we getting more clarity from Greg Abel on that score? So
I think we heard from Warren Buffett. He was asked about the India story, and he said, I'm going to leave it up to my, my predecessor here, my next successor here in Greg Abel. He said that there are likely to be unexplored and unattended stories here. And I think if we were to look at the Japan playbook, because, he speaks about it very, very fondly. Prior to 2019, 2020, prior to that sort of interest from Berkshire Hathaway, these companies were seen as very complicated. They were not sort of these streamlined pure plays that global investors tend to really like. And since that interest, if you look at their share prices, their respective share prices, they've gone up by more than 200%, well outperforming the benchmark Nikkei 225. So I guess it really speaks to his strategy of finding, he says, great companies at fair and, in Japan's case, pretty cheap prices, right? But I think when it comes to India, the valuation story is going to be one of the complicating points because it's such an attractive point already for investors. And there's always been talk about the fact that, yeah, valuations are pretty high for Indian companies, right?
And you've got to wonder whether a US-India trade deal may really give an investor like Berkshire a little bit more clarity over the diamonds in the rough within the Indian landscape. Thank you very much indeed for that, Lynn. Coming up on the programme, amid record high prices, does gold still shine as the investment of choice for Indians? We'll discuss that and how new offerings in the asset class are piquing investor interest. Sasha Jain of the World Gold Council joins us next. Welcome back. It's a lighter session here in Asia. Let's take a look at the markets anyway. Japan, China, Hong Kong markets are out of play today, but we are seeing some heavy losses, particularly pronounced on the TAIEX, down by 1.2%. Was down by as much as 2% earlier on in the session, so clawing back some of those losses, but still deeply negative. And elsewhere, we are seeing some resilience in the North Asian markets on the Kospi and in some parts of Southeast Asia. So struggling for direction broadly. We are counting down to the market open over in India. This is how we are shaping up. Let's give you the futures picture. 24,538 is where we are expected to kick off in terms of the outright number for the index. And that would represent an incline of about 100 or 200 points, given where we left off on Friday at 24,346. Dollar-rupee exchange rate at 84.45 on the nose. Let's give you an update. In the Indian IPO space, hospitality player Oyo is hitting the brakes on its IPO for the third time. India's largest and fastest growing hotel chain is delaying the move amid market uncertainty and pushback from SoftBank, its top shareholder. Company now aims to go public by early 2026 once earnings look stronger. Now, India wrapped up a busy gold buying festival last week. The Spring Festival saw customers shying away from buying high-value gold. Stores were open for extended hours, offering discounts and deals, but record prices of the yellow metal dented volume growth. However, interest in new offerings like gold ETFs and digital gold surged. Gold prices are currently shaping up like this. They have been coming off from their highs. 3,260. We continue to pivot around that level. Let's bring in Sachin Jain now, Regional CEO, India of the World Gold Council. Sachin, welcome to the programme. It's been said that the best cure for high prices is high prices. So I'm just curious, how has the rally to a record impacted demand in the world's second largest gold consumer?
First and foremost, a big thanks to having me on your platform, and
Pleasure,
it's an honor and privilege for us. You mentioned about a few things, and India has been very exciting on gold. Gold has been part of our social fabric and continues to be. In the last few weeks, as we saw the whole rally that has been happening globally and in India, it's been quite interesting. And the two facets of it, from an Indian perspective, the financial side, and you mentioned about ETFs, digital gold and all of that, which has been growing substantially. We think that a product like ETF is still at a cusp, and 2025 will be a real growth area for ETFs and the financialization investment side of gold. On the jewelry side, which tends to be a very large segment in India, we've seen consumers, and even historically, whenever the prices go up, the consumers tend to wait and watch. Wait for the stability or at least some pause in the acceleration or deceleration, and then consumers come and buy. And hence, as an outcome from the first quarter, we saw overall about a 15% degrowth in volume terms, but almost about a 20% up in the value terms for gold consumption in India. And if you break that down, consumption for investments went up by about 7% in volume and a whooping 54% in value, whereas for jewelry, we went down about 25% and about 8 to 9% up on value. Now, last week, we had the most important day, or the second most important day that we see in India, called Akshaya Tritiya, where consumption or buying of gold tends to be very auspicious. Families come out, and you mentioned about a little sort of correction that we saw from $3,500 to about $3,200 level, and consumers were out on the floor. We were supremely shocked, or I would say pleasantly surprised, to see the amount of footfall. We saw a lot of young consumers coming in, a lot of tokenized buying. I would say that we'll have the final numbers by end of play today, but broadly I would say a small drip in volume, but about 10% up in value for that day compared to last year.
That's interesting.
Sorry.
So if I may, Sachin, sorry to interrupt you. If Akshaya Tritiya is a litmus test for the buying appetite of the Indian consumer, then what does it mean for the bigger festivals like Diwali and Dussehra later on this year? And do you think that buying will be relatively undiminished, or is it going to be impacted?
I think what we've been seeing in all our consumer surveys is that the confidence of a consumer for gold is supremely high right now and will continue to be like that. And India, when you look at India, it's two parts of the consumption. There is an urban India consumption, there's a rural India consumption, which is also very significant. And the fact is that while in the urban side, people talk about investments, returns, alternative assets class, and so on and so forth, in the rural part of India, which contributes to a significant 45% of the consumption, over there, gold is considered as a saving, and you keep continuously invest in a saving. And hence, when you look at your asset class over a period of time as gold, and there aren't too many avenues, that feeling with the increased price is very, very strong. So I think what I'm trying to say is that investment demand on borrowed coins, ETFs, as we talked about, is going to continue. It's already very strong. And from a jewelry, we believe that consumers will come back.
Sachin, a younger demographic, is that emerging as a new driver, as a new buying force in the gold market, as opposed to what the younger generation typically tend to gravitate towards in the investment arena, cryptocurrencies and meme stocks? And what is the World Gold Council's strategy for India specifically to capture what could be a new investment cohort?
Well, for us, the whole, I mean, you talked about young India, and by end of 2024, almost 72% of India was millennial or younger. So if you have to build up future businesses, be it investment, be it jewelry, you really got to focus on the younger and the youth and how they consume. And hence, two parts of it. Firstly, on the investment side, so a lot of digital gold, a lot of ETFs and everything. If you go in the deeper demographics of who's consuming it, it's been largely driven by younger consumers. And I think it's to do with digitalization. It's to do with the ease on living a life on the mobile phone and stuff, and also a gravitation or a move that we've seen over the years that physicality in India that mattered so much is people are okay now to having it digitally owned. So largely led by younger consumers. Now let's talk about the jewelry side. On the jewelry side, gold has had a very important cultural nuance on cultural themes and stuff. And as World Gold Council, we're now focusing on bringing, what we call internally gold being the new gold, even in that space, where we're trying to bring it fun, youth, exciting, new products, new ways of retail, really upping the game on competitive retail, training, technology on floors. So you would see a lot of stuff happening on retail side as well. And also on the other side, we're looking at strengthening the awareness of products like ETF.
That's very interesting. Just give us a bit more colour and an overview on what exactly is on offer, Sachin, in terms of digital gold in the marketplace in India, and how widespread is this asset class, and give us a sense of adoption as well, and how much demand is it generating precisely compared to the more conventional bullion, gold bars and coins?
So let me give you a bit of numbers of ETF and digital gold. Let's break that up. So ETF, let's talk about 1st of January 2024. The AUM of ETF was about 41 tons. Like, let's talk about 1st of January 2025, where the AUM of ETF went to about 59 tons. Now, you could argue to saying that 18 tons is not a big deal, but 18 tons over a 41 ton AUM is a significant percentage up. And as we fast forwarded as of today, or I could say at the end of last month, we saw the AUM moving up to about 68 tons. Now, it's growing rapidly, and we believe that there is a huge potential on the ETF side as it gets more and more easier, popular, and the fact is that it's a regulated product. It's backed by the SEBI promise of that every time you buy an ETF, it's backed by physical gold, and that promise is not known to a sort of consumer on the street, and hence I think the awareness is important. Let's talk about digital gold, which fractionalizes gold, and you can buy it online by various platforms. And it's growing. I mean, the fact is that today we have almost 45 million consumers who have consumed gold via digital gold. The issue is that it's not regulated yet, and there is a lot of work happening, and we're working with the government, and I'm pretty certain that very soon there'll be a framework of what is the regulation around digital gold, and I think that's really going to bring a lot of strength that nobody I mean, it's a safe investment and can move forward. So that's the sort of flavor. Now, physical gold in terms of bars and coins continue to be still dominant and very large in the overall consumption. So from the about 30% of the consumption in India tends to be on investment, out of which about 80 to 90% tends to be on physical gold.
Yes. Sachin, do customs and import duties need to come down further to boost gold demand within India?
Well, I think the government has done a phenomenal job last year in terms of, our respectable finance minister went on to share the budget last year on the 23rd of July. And in one simple sentence, she did really turn around the biggest issue that was there in the business, which was the grey business and imports without custom duty. And I think that whole, the Indian consumer today is pretty much at parity with the global consumer. The business which is organized is operating the same way as, smaller businesses. So I think a big step has already been taken. And I think the way government is looking to work hand in hand with the industry, I believe as and when required, that the right steps will be taken.
And just getting back to the ETFs, what are inflows into physically backed gold exchange traded ETFs telling us about safe haven and investment demand, Sachin?
Well, we've seen actually two extremes on this consumption. On one side, we've seen the family offices buying very large ticket sizes of ETF. And then on the other end, the very young India trying to experiment it and trying to grow. So as I mentioned to you, last year we saw an 18-ton AUM increase on ETF, which is approximately about 37-38% of the overall AUM of ETF in India, gold-backed ETF. And in this year itself, starting from January to now, we've seen an additional about 8 to 9 tons already added up. And I believe that's going to go strongly. The numbers for Akshaya Tritiya and around will be out with us by end of this month. And we know that it's been a very strong thrust that the ETF sector on gold has got on Akshaya Tritiya as well.
Sachin, how active a buyer has the RBI been lately from a diversification point of view?
Well, pretty interesting conversations with RBI as well. I mean, 2023, they bought a total of about 17 tons into the additional investment that they did in gold. Year 2024, this was about 78 tons, which is very significant. And even quarter one, we've seen buying in January and a pause in February and back again in March. And the numbers for April will be out. But I think as the leadership of RBI has been talking about, their strength and their interest in gold continues. And we'll see what their outlook will be for the coming time. But it's been pretty consistent, strong, and in line with what the leadership has told us.
Sachin, do you feel, when you look at the broader outlook for the gold market and India as a driver, as the second largest consumer of gold in the world, does it look like the price of gold has hit a peak, in the near term at least?
Well, I think from the price point of view, we at World Gold Council don't really indicate what's going to happen on price. But I can tell you that the pillars on which gold pricing is built on are pretty much strong and in favor of mid to long term sort of indication of where gold is going to head. Now, your point of what's going to happen in India, and I think we all have been hearing about the phenomenal destination laid out by our respectable Prime Minister, which is called Viksit Bharat 2047, and where India moves from being a developing economy to a developed economy. And there are various numbers floating around whether the size of the economy will be $23 trillion or $30 trillion. The fact is that from the size of economy today, there will be an additional 3 to 4 Indias that we're talking about getting added up. And that also means that pure money in the hands of people will go up. Historically, what we've seen is that every time there's a 1% increase in the incomes of people, we see a positive impact of about 0.9% of consumption of gold, or increased consumption of gold. So I think when you look at the Indian pyramid, so a lot of income classes where consumption or consumption of gold still is aspirational. And I think with sheer increase on per capita income, the Indian story will drive the overall growth story of the global gold demand.
Sachin, do you feel that cryptocurrencies could challenge gold as an investment or even as a safe haven?
Well, I think I'm not an expert in crypto, but I think from an Indian perspective, it's still a very young asset class, and I think it has to prove its worth. I'm sure that government, which today doesn't sort of give a blessing on it, I'm sure there work happening around it. We need to recognize it as what it is, and there will be certain investor in India based on their appetite to take risks and stuff that will invest. But I think the fact that will it move or disturb or sort of impact the overall reason why gold exists as a safe haven, I don't think that's anything happening in India, particularly in the near term.
Sachin, if there is a US-India trade deal, I was speaking to an earlier guest about the positive ramifications, and it will be felt throughout the broader macro economy if there is a BTA that is finalised and concluded. To what degree could that release the animal spirits amongst the consumer, and to what degree could that give them more confidence to go out and buy gold if the economic climate is looking better?
Yeah, so as I said, I think it's going to be, there are a lot of indications of if this deal happens to various degrees, what's going to happen to our GDP and how it's going to positively impact. Yes. There's certainly a flavor in the industry and in India in general that this pact of India and US is certainly going to be positive. Now, to what degree is going to come out, but as I said, that from a gold standpoint of view, I would take out speculation for 5 minutes, but also purely look at that as there will be the increase of our GDP and there will be more money in the hands of the end consumer, I believe that will get invested, in some subsequence in gold. And hence the strength from mid to long term of what gold means to India, what it means to the investment class, what it means to the consumer, what it means to rural and urban consumer. Every element only points to one direction, that the strength of gold is only here to stay and get stronger.
Sachin, we'll leave it there, sir. Thank you very much indeed for joining me. Sachin Jain there, Regional CEO, India of the World Gold Council.
It's a pleasure and honor.
Indian markets, thank you, sir. Indian markets have joined the trading day. Lots of movers in the region to look at. We're back in 2 minutes. Welcome back. The Indian markets are now online. Let's give you a sense of what the Nifty 50 is doing at the early open, and it is putting on about 0.4%. Let's give you the exchange rate as well. Dollar rupee at 84.3960. Let's take a look at the stocks that are moving, and the Adani group of stocks specifically are looking like this. Reports say that the group's representatives are meeting US government officials to push an end to the bribery cases against them. Broadly, they are in positive territory with the exception of Ambuja Cements and NDTV. In the meantime, the Indian markets regulator, SEBI, has alleged insider trading by Pranav Adani, nephew of the group's founder, Gautam Adani. Pranav Adani holds a director position in several of the group's companies. Let's look at some of the movers in the Indian markets today. State Bank of India's shares reacting to the earnings report card. And this is what SBI is doing, down 1%. India's biggest lender said loan growth this year will be flat as tariffs dent the macroeconomic outlook. This as its quarterly net profit dropped nearly 10% due to narrow net interest margins. We're also watching shares of PNB Housing Finance after the US private equity firm Carlyle Group sold its entire 10% stake in the Indian housing finance company through a block deal worth over $300 million. Carlyle was the second largest shareholder in PNB Housing Finance and held its stake via an affiliate called Quality Investment Holdings. PNB Housing down by 0.4%. Let's bring the conversation back home to Singapore. The ruling People's Action Party winning a convincing majority at the weekend's elections. JP Ong joins us now. And JP, tell us how the city-state is planning to navigate tariffs and domestic issues now that there is continuity.
Good morning, Sri. And yes, continuity seems to be the common theme across many of the elections, not just here in Singapore, but elections that were held over the last couple of days. And it's the clarion message that saw the People's Action Party win 87 out of 97 seats, more than enough for a supermajority in the parliament, and also an improvement in the popular vote, garnering more than 65% of overall votes here in Singapore. And their message really was that this is not the time to change course, to change drivers, and that we need a strong and credible and reliable group of leaders, similar to what the PAP has provided Singapore for the last 60 years, to guide them through the global uncertainties. And you mentioned that, right, Sri, the ongoing issues with regards to global trade and the uncertainties brought about by the tariff regime and the realignment and perhaps the degradation of free trade in the world, that's really putting this open economy and this trade-reliant economy much at risk, actually. And this is the call now and the challenge for these leaders. But we have to remember they're also balancing something else, because there's a growing call from many Singaporeans to address some local issues, such as the cost of living. As you're well aware, Sri, in recent times we've seen, on more than one occasion, some public housing units that have gone up in the resale market at over 1 million Singapore dollars, and also many bemoaning the cost of living and the cost of just getting by here in Singapore, including the cost of doing business, as other local issues that also need equal attention. Now, how they're going to balance these two will be important, but it's also important to note that the growing issues and cost pressures in Singapore might also be a function of these global issues that the PAP will have to address. But how they thread this and also making sure that they have the diplomatic balance also in line is going to be the key issues for them moving forward. But so far, the People's Action Party, much since the founding of Singapore as a city-state, continues to be at the helm and will guide them over the next 5 years. Sri, it's back to you.
JP, excellent coverage. Thank you very much indeed for that. It's not just Singapore, Australia's ruling party, also getting a strong mandate in elections on Saturday. Official vote counting hasn't been completed, but there are enough votes to know that the centre-left Labour Party has scored a decisive landslide victory with Prime Minister Anthony Albanese, the first Prime Minister in 2 decades to win a second consecutive term. Opposition leader Peter Dutton, who was favoured to win just a few months ago, has lost his seat of 24 years. Meantime, US futures are tipping a softer start, with Wall Street to begin trading tonight. CNBC's Dominic Chu has more on what to expect this week.
On Monday, the Department of Education will start to collect again on defaulted student loans, something that has not been done since March of 2020. Roughly 5.3 million borrowers are in default. Plus, Skype will shut down operations on May 5th. Microsoft says it's getting rid of the platform in an effort to streamline its communications offerings. The Federal Reserve will begin a 2-day policy-setting meeting on Tuesday and will announce whether the central bank will move on interest rates on Wednesday amid pressure from the president to make an interest rate cut. Plus, the long-coming Real ID change goes into effect on Wednesday, requiring all domestic air travelers to present a compliant license or other form of approved ID, such as a passport. And on Thursday, OpenAI CEO Sam Altman and other AI industry leaders will be on Capitol Hill to testify before senators about strengthening the country's global AI position. I'm Dominic Chu. Get all your business news on CNBC.
Thank you, Dominic. Let's take a look at the Asian markets once more. And thin on the ground in terms of traded volumes, because a number of markets, as you can probably deduce there from your screen, are still closed. And that leaves the TAIEX as the loss leader at this point, down by 1%. But the picture was even grimmer earlier on this session. It was down by 2%. The market there also had to contend with a resurgent Taiwan dollar, which was up by over 3% against its US counterpart. Let's give you Australia as well. Post-election, down by 0.7%. And elsewhere in Southeast Asia, it is looking reasonably resilient. That's it for today's programme. Tomorrow we will unravel what's behind the bounce in the Indian markets. Feroz Aziz of Anand Rathi Wealth joins us. We'll also talk about climate investment in India. That's all the time that we have today on Inside India. Keep watching CNBC, Access Middle East, and Dan Murphy up next.